What's up, everybody? Today we're talking about taxes. I know that sounds really lame, but this is actually the good part about taxes. This is how real estate helps you when paying taxes, as in helps you to not pay as much taxes. This was a very important point for me when starting in real estate because when I worked, I had a sales job and I was taxed at the highest level. Our first businesses in insurance as brokerage salespeople, we were taxed really high on a cash flowing business. My father would always say 99% of our assets go home at 5 o'clock, which was true. The assets were people. We worked, we were paid commissions, which is high cash flow. What that meant was we were taxed at the highest rate because we didn't have any of the things that real estate offers to give us tax deductions and depreciation and all the wonderful benefits, which we're going to talk about today. And there's three main areas of focus. So, number one, we're going to talk about deductions. And a lot of these actually applied to us in the insurance world. They're business deductions, which self-storage offers. Number two is depreciation. So we're going to go into depreciation and talk about what it is. We're also going to talk about cost segregation within depreciation. Fun stuff. It saves a lot of money in taxes. And then third, we're going to talk about is debt and loaning and how that can make you a lot of money and not pay taxes. I know it doesn't make sense, but we'll get to it because we've done this with every single property and it's very key to the compounding nature of real estate. This is one of the beauties. Let me explain to you why it makes such a big difference. When I was taxed really high and we wanted to buy an investment property, I was paying for that property with after-tax dollars. That means that I was taking 50 cents of a dollar that I earned and put it into an investment. Let's say that that investment made 10%. Well, that investment at 10% would take me years just to get back to a dollar that I'd previously earned. When doing the math, when looking at our investing schedule, trying to become financially free, that was extremely frustrating because I'm saying I earned a dollar, I can only use 50 cents of that dollar, and then that investment has to grow X just to get me back to what I'd earned. This can just kill your rate of compounding. Now, when you have a real estate business and you have real estate assets, I can use that money coming off the real estate and I can apply those three things we talked about and I can reinvest that money now at either a super low tax rate or no tax rate at all, and I can get a return again. So what that means is I'm actually getting a dollar and I'm reinvesting that dollar and getting a return. And then that return also has all the tax benefits and I can keep doing it over and over and over again. This allows you to grow much faster. That's also why we employ a value add strategy, because of the third one, which is the loan part. So this is one of the best and most amazing parts of real estate investing. And self-storage and all other types of real estates has these advantages. Now it's important to know that I'm not saying don't pay taxes, because it's not that we don't pay taxes, we do. The taxes happen within the LLC in the form of property taxes. We have a lower tax rate after it leaves the LLC, a limited liability corporation. That's the structure of our business that we have. The after-tax dollars, or the tax dollars that come to us as income, we get to offset for these tax advantages. So we're still paying taxes. We pay lots of them. In fact, we pay millions in property taxes. But the money that comes to us, we get tax benefits from. So let's get started on number one. So in real estate, we get to apply tax deductions like businesses do. And there's a whole list of deductions that we get to apply that you can deduct from your taxes. These include things like taxes that you already pay, like property taxes, mortgage interest, property management. These can be everything from advertising expense, legal and professional fees, travel, mileage, expenses associated with the business of operating your property, meals, closing cost. There's a lot of deductions that come into the actual business of your real estate. Now, in self-storage, this is important because we view this as a real estate. And the big ones that come in, like repairs, maintenance, and capital improvements, these are big dollar expenses that you have to put back into the business. These are all applied to deductions. Now, the rate of the deductions and how they apply, I'm not going to quite get into that because that's for your CPA to advise you on, and that can depend on a whole lot of things. But you can apply all of these to your taxes to deduct from the taxes that you have to pay, therefore lowering your tax bill for your income tax. Number two, the second thing that we talked about is another thing that is very unique to real estate, and that is the depreciation. So in taxes, we look at this asset as a depreciating asset. So appreciation means it rises in value. Depreciation means it lowers in value. Think about it like this. You have to repair things in your property, and the taxes reflect the fact that your doors are going to get weaker. We have to go in and we have to change out doors and lights, and there's all sorts of things that don't have a full lifespan, as in they're not going to last 30, 40 years. So as those things depreciate, we get to count that depreciation towards our tax bill. As in, these things are lowering, which this is one of the magical things about real estate, because real estate has appreciation. So the depreciation, you get to take off your taxes, all while your property is appreciating. Now, appreciation is going to be very key in our last subject, but let's stick to depreciation real quick, because not all depreciation is created equal in real estate. Now, there's something that is called a cost segregation that you can do. This line items things that depreciate faster than other things. To give you an example, a building and a light bulb, for example, don't depreciate at the same rate. And that's kind of obvious if you think about it. So what cost segregation does is it line items all those things that depreciate faster, and they apply it now. So you can get a cost segregation study done, and it will pick all the things in the depreciation aisle that depreciate faster, and you can apply that to your taxes. That means you can take more depreciation up front and sooner. This is fantastic. We just bought a storage facility for $6 million. We paid roughly $1.5 million down, so we put down in equity for it. We had a cost segregation done on the property, and we are going to take that depreciation all up front, and it's going to be the tune of almost $600,000, maybe a little more. That's roughly 50% of our down payment. That wipes out our taxes that we're going to have to pay on the profit and the cash flow of that business just with the cost segregation study alone. That property making $150,000 a year in net profit, let's say, we will not pay taxes for years to come on it because of the cost segregation that's done. This is a powerful tool, and it gets back to this idea that now I'm getting an entire dollar back, and I can reinvest that dollar back in. The reason why depreciation exists is because we don't want cities falling apart. We don't want things to be dilapidated. So the government's encouraging you to reinvest money in and keep that building up and going. So I know that if I need to do a large capital expenditure on that asset, let's say part of the building's broken and I want to fix it up and make it look really nice, that I can depreciate that off my taxes. If not, maybe I'm just going to let it fall apart and say it's not worth it because I have to pay with after-tax dollar. That means I got to now take a dollar out, and a dollar worth of work is really, to me, $2 because I have 50 cents. I hope that makes sense. But after-tax dollars, if I had to pay taxes on it, it would be very inefficient to re-put into that building to make it look nice. We want our communities to look good. That's why this tax advantage exists, and it's a great one for real estate. So we keep our properties looking nice, we use our different expenditures associated with the business that we're running through, and also the depreciation to lower our overall tax bill. Now there's the last part, which is a really good tax advantage that we're going to talk about. So the third one. Right? The third one is borrowing. This is the loan. Now, why is this such a good tax advantage? First of all, on the example that I used, we bought a property, $6 million, you put $1.5 million into it. We have debt payments that we have to pay. This is ongoing payments, right? That gets to be deducted from our tax bill. And these are mortgage payments, right? You have this with home mortgages and all sorts of real estate. But there's another one associated with buying that I want to talk about. The other one that we use, and we use it a lot in our value add strategy. After we improve the property, the equity grows because we grow revenue in our storage facility and any other real estate asset by charging higher rates. The equity therefore grows, it's worth more. So if I had to put 30% down on a property, let's say that property is $10 million just for ease, or we could even say it's worth $1 million. Let's say it's $1 million. So we have $1 million property, we put 30% down, that's $300,000. We improve the property, now that property is worth $2 million. I'm using very simple numbers, obviously, so we can understand it. But it's worth $2 million. That means we have now $600,000 in equity when we originally had $300,000, because that's the money we put down. Now I can go refinance that again. So I go to the bank, I refinance, say we've improved it. I only need 30% down. So I refinance it. I have still the 30% down. 300,000 comes back to me because the debt on it was still associated with the lower debt. So that spread is what I'm talking about. It's a $300,000 improvement, refinanced, the bank gives it back to me, that goes onto the loan, which the asset is paying. I improve the property, I double its value, I refinance it, put more debt on the property, take that out, even though the debt ratio is still the same. It's still 70-30. It hasn't changed from what I bought it because of the improvements. That $300,000 that comes back to me, because it's in the form of a debt, is tax-free. This is the key to compounding your real estate returns. Anybody that listens to Brandon Turner or Bigger Pockets has heard of this strategy, and it's called a BRRRR, right? So you buy, you rehab, you refinance, you keep doing this thing. So you go along with your BRRRR, and it's all the value add strategy. You're buying it up, you're doing repairs, your maintenance, you're improving it, you're getting tenants' revenue to come in, you're refinancing, and you're repeating it. Hence the BRRRR, right? And then you take that money that you're repeating and put it back in, and you haven't paid taxes. This compounds your capital out faster. It grows wealth, and it pays you, all while not changing your debt percentage. This is the most powerful part to me in real estate investing and the tax advantages from it. I can get my capital back out. I can make 100% return. I don't have to pay taxes on that. I can reinvest that into another property. I'm starting the cycle all over again. So now that I've reinvested into another property, I can get more business expenditures to deduct from my taxes. I can get more depreciation to deduct from my taxes. I can improve the property again, take the money out tax-free once again, and just keep doing the property. Most people that I've ever met that have large real estate portfolios, really large, 100 million plus, this is the key. This is the secret to their success. They can reinvest capital, grow it, and deploy it tax-free. Now this helps everybody. This helps communities, this helps investors, it grows our economy, it makes our communities look great. So these tax advantages are real and they're helpful for everyone involved. And it's one of the major reasons I got into real estate. So when I earn $1 now, I get to keep $1 and I get to reinvest $1. I'm way more willing to reinvest because I want to keep those tax advantages and I want to keep the machine going. That helps communities. I'm buying underperforming assets. So these are really normally trashy, dilapidated buildings and things that we're buying, and we're improving them. The cities are happy, the tenants are happy, the customers are happy. It's a wonderful system to work in, and the advantages are awesome. All right, everybody, so the tax advantages in real estate now you can clearly see. I haven't gone over all of them, and I am not a CPA. These are the things that we use within our business, and there's more, and we'll talk about tax advantages for a long time to come. In fact, on my podcast, we've actually had specialists in cost segregation come in and talk to you and walk all the way through it. So you can clearly understand this and have content. Go to Self-Storage Income on the podcast and go look on there. So we have guests, we have people coming in and talking about it. But this should give you an understanding and an idea why these tools are so powerful. But everybody, if this has been helpful, if you like it, please subscribe and like. That's how you can help me. And I can keep telling you guys what we're doing to grow our real estate portfolio, create wealth and freedom. I hope you guys like it. Now go get after it. All right, so this one is how real estate lowers your taxes. Okay,